In this video, I'm going to talk about Adobe. If you had invested in Adobe 10 years ago, you would have outperformed the index. Adobe is in green and the S&P 500 is in gray. So I'm asking you this question: do you think this trend will continue? Do you think if you invest right now in Adobe, will it perform? In this video, I will do a quick analysis, fundamentals, moat analysis, because a lot of things are changing for Adobe right now. So the stock is dropping, as you can see with this green chart. Do you buy right now? Is it cheaply valued? Do you have growth opportunities? This is what we will talk about. Welcome to this YouTube channel. My name is Christophe Nour. I've been investing in the stock market for almost a decade, and I have achieved a performance of 25% per year, investing in great businesses. So Adobe is a great business. So far, so good. You all know Adobe. They have three key segments. They have the software, recurring, high margin business. And let me show you some financials, some margins in case you have a doubt. So I'm here on the website called Guru Focus. You see that Adobe is a strong, big business, $200 billion of market cap. And yeah, this is Photoshop, Adobe Premiere, software, editing software. They have 90% gross margins, and you see that over the last decade they changed to become a recurring revenue business. So if you look at the charts for revenue, you see that growth accelerated recently, and this is literally up and to the right. You see the blue chart, this is the revenue going higher. Same thing for the net income. You see that growth accelerated recently, and since 2020 growth has stabilized. This is for the net income, for profitability. You see that for the free cash flow we are going stronger every year, up and to the right, and since 2016 growth accelerated drastically because it became a recurring revenue business model. It generates a lot of cash, no debt issue, efficiency improved. Since 2016, the ROIC, the return on invested capital, a measure that shows efficiency, improved, and now we have a ROIC of 20-25%, and they do some buybacks. Okay, this is a clear picture of what they do, growing financials, and now it's available at a PE ratio between 20 and 30. Price to free cash flow of roughly 20. Okay. Do they have a debt issue in the short term? No, the current ratio is above 1, so they don't have issues about liquidity in the short term. Operating margins at 30%, net margin 30%. What is wrong about this stock? Why is the stock dropping? So I will go to this very quickly. I want to show you that for the financials, in terms of revenue, you see the change in business model in 2016. You see when the company became a recurring business model, high margin here. In 2015-16, something definitely changed for the business. And there is a worry right now that with AI, the moat of Adobe may be weakening, because Adobe is famous for Photoshop. Now with AI, with some free tools, you can do some Photoshop completely for free. Now also Adobe is famous for the editing software. Now there are some new AI tools that can allow you to have some free editing, cheap editing. You don't need to subscribe to Adobe's licenses to do some editing. You have some free alternatives. The competition for Adobe is restrained. I mean, you have Canvas that is acting as a competitor, and I mean there were some rumors of buyout, but no big competitor when it comes to Adobe. The reason the moat is deteriorating for Adobe is just thanks to AI, and nobody knows if this trend will continue. So if you look at the cost of goods sold decreasing, that means more margin, more R&D expenses. They scale very well. Net income is going up and to the right, and you see that the business has not always been like this for Adobe. What I want to show you is that it's only since 2016 that the business is extremely good. Before that, it was a stable business, not growing much. Same thing for the earnings per share. You see that for 10 years, between 2004 and 2014, no growth in earnings per share. So now we have a big trend. This trend can stop, and the business can, if the business continues to face some difficulties in the future, this trend can completely stop. And if you look at the diluted shares outstanding, you see that they do some buybacks. The number of shares is declining. Very well. So this is your story. And in terms of the cash flow, what I don't like about Adobe is that there is a threat to their moat now with AI, image generation, video generation. And what does Adobe do? By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. In the past few years, Adobe tried to acquire Figma, but it was a long process, and seems like the merger was abandoned. Figma and Adobe are abandoning our proposed merger. So apparently they abandoned the $20 billion acquisition of Figma. Figma, which is one of the key competitors of Adobe. So I don't know what it means for their industry. I'm not an expert in this industry. If you have some knowledge about this industry and you are very familiar with the digital editing software like this, you can do your own due diligence. But the big question is, what do? They try to acquire a competitor, doesn't work out. Do they try to invest in R&D? Yes, kind of, growing, not more than in the past. Do they try to do some bolt-on acquisitions? Not necessarily. Do they try to integrate AI into their tools? Yes. And how are they using their cash? I'm here on Stock Unlock. I'm looking at their cash flow statement, and you can see how they are using their cash. So net income is going up. That's our D&A that is stable. Working capital, nothing big here. Non-cash item, no. What about the property, plant, equipment? That's the capex. If you invest in capex, you invest in new facilities or new warehouses, properties. That's the investment inside your business. The capex for a software business is likely to be small, but I want to spot a trend here. And what I see is that the capex, the reinvestment, has peaked in 2022. And since then, nothing. Another question for you is, why is the capex declining? I'm guessing that the decline in capex will cause the free cash flow to spike. If you look at the free cash flow, spike in free cash flow. Yes, okay. And most of the cash flow is used to do some major buybacks. This is the amount of buybacks that the company is doing. And you see an accelerating trend. The company is using a lot of their buyback, or a lot of the cash flow to do some buybacks. So, okay, let me compare now the free cash flow, this line, versus the buyback, because I think that the majority of the free cash flow is going into buybacks. So free cash flow, what can I check? Quarterly, yearly. Yearly will maybe show something else. Free cash flow. For this line, it was $6 or $7 billion in 2021 of free cash flow, $4 billion of buyback. In 2022, $7 billion of free cash flow, $6 billion of buyback. In 2023, $7 billion of free cash flow, $4 billion in buyback, more than half. And then buybacks accelerated a lot in 2024. Yeah, that's 2024. $8 billion of free cash flow generated for $9 billion in buybacks. I mean, that's strange. Yeah, strange. Two scenarios here. Either the management doesn't care about their moat deteriorating, and they just think that their stock price is undervalued and they do some buybacks, and they don't see the risk. And if that is the case, this scenario is very risky for Adobe. Like, their barriers to entry may completely collapse. the moat may completely collapse and management is burning cash doing buybacks when it shouldn't do buybacks. Maybe this is scenario one, and this is very risky for shareholders. Maybe this is the reason why the stock is collapsing. Like, guys, management, it's time to reinvest a lot of your earnings and to reinvent yourself. And what do you do with the cash? You do massive buybacks. Like nothing is happening. Your moat is in danger and you are burning cash. This is your first situation, first scenario. The second scenario is that the AI risks are overblown. These fears are overblown. The AI trend is likely to continue like this, but the recurring aspect of the software will not be impacted. Maybe Adobe is very smart and will implement AI into their software, which they are currently doing. I saw some great videos from Adobe and great products, great services, great software. I've seen some videos. I don't use Adobe as a software, so I'm not a customer. I don't really know. But I've seen some great products. So the second scenario would be that they implement AI into their products. They are fine. And everybody is panicking for nothing. And they believe that in a couple of quarters, people will realize that Adobe is a clear leader in their industry. So in this second scenario, buybacks are the best thing to do. By the way, doing buybacks when your stock is going down is quite difficult because you will face this situation. People will hate you. You will have a lot of critics and say, what are you doing? Are you a bad CFO, bad management, bad capital allocation? And you need a lot of courage to go against the trend and invest in yourself, buy your own shares back. So that's one of the two scenarios, and I'm not an expert of this industry, so I have no specific insight. Maybe you have, so you have to do the work now. Either scenario one, they are struggling, and this is literally them burning cash because competition is coming for them and is going to eat their lunch with AI. Or two, they are not complacent. They are just aware that they are the leader and they will continue to be the leader, and the numbers are still growing. More users, more customers, more recurring revenue. This is fine, and the margins will be fine, and people are freaking out for nothing. And this is the best way of using the capital. Use all your free cash flow and do buybacks. So we will see. And I want to check the valuation, and that would be it. Free cash flow is growing. I mean, they doubled down on buybacks in a big way. I don't know if they will continue. Their guidance for 2025 was changed a little bit. Like they implemented a new metric for recurring software. So the guidance for 2025 in their latest report, the guidance for 2025 was impacted, changed a little bit. And strangely enough, the stock price declined since then. Seems like people don't really understand how Adobe uses their accounting. Is using their accounting. But if you look at the past 10 years or even more, 20 years, margins are extremely high. The net margins are extremely high. Now we have net margins above 20%, 25%. Free cash flow margin are above 30%. And if you look at the PE ratio for this business, let me put quarterly basis. Where is it? Oh, I don't have the PE ratio. Here we go. If you look at the PE ratio for this business, you see that the valuation, the PE ratio, has always oscillated between 30 and 50. So no big deal actually. No big deal actually. We are not in extreme cheapness. We are not in an extreme scenario. I can show you an even better way of viewing the valuation. It would be to check the free form. By the way, if you want to use this great website, Stock Unlock, I have a link in the description below. You have a discount. Voilà. This is the PE ratio. This is the price earnings ratio for Adobe. You see that it has declined a little bit, but not that much. I mean, you went from a PE ratio of 50 to now 30. This is not a screaming buy at all. And if you check the valuation in the past, since the business became a recurring business model, the lowest valuation we had was 27. Now we have a PE ratio of 32. There is still room to decline, and it will still not be cheap. So now let me check the price to free cash flow. Maybe it tells another story. So maybe that's a better way of looking at the business. If you look at the past PE, price to free cash flow, like in 2012, the business was not a recurring business model. So the PE ratio, price to free cash flow, doesn't mean much. You have to compare the situation right now to the situation starting in 2014, when it became a recurring business model. And the lowest valuation we had during that time was in 2022, with the price to free cash flow of 18. That should be reasonable. That should be a good buying point, a good price to buy. And it went up to 40. I mean, valuation is changing a lot for this business. Be aware of this if you buy the stock. Valuation will continue to change. And now price to free cash flow is 22. So I'm not an expert about this industry. I don't think I will touch the stock. I'm afraid I don't have enough information to decide if we are in the scenario 1 and the business is doomed, or scenario 2 and the business will thrive in the future. And depending on which scenario it is, the business will do wonderful or terrible. So everybody has their own edge, right? If your circle of competence is into software and editing, this is your time to do the analysis. For me, it's a quick pass. I don't think I have enough information, enough insights to have an opinion on Adobe. It's not a buy for me, and I think for a lot of people, it's not a buy, because AI trends can be very scary for this business model. So we'll see how it goes, but please do your own due diligence. What is for sure is I will not buy the business. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.